fundsupermart.com.
Hi, what is your outlook for the US high yield market for 2013 and over the next 2 to 3 years?
So when trying to figure out an outlook for any asset class, there's really two factors to consider. One is the fundamental outlook, and then the other variable to consider is valuation. So when I look at U.S. high yield, valuation looks fairly valued. It's not overly attractive or overly cheap, but that's justified based upon the favorable fundamental outlook. So when we talk about fundamentals in U.S. high yield, I look to something called the default rate, the percentage of the market that's likely to default. It's at a below average level today, and my expectation is over the next 1 to 2 years that the average default rate in U.S. high yield will stay well below that long-term average. So valuation is fair. Fundamentals are very favorable with the improving economy in the United States and the low probability of high default rates. So I think the outlook is fairly positive overall for U.S. high yield for the next 1 to 2 years.
Fixed income markets, including the high yield sector, have enjoyed a good year in 2012. What are the drivers and risks to performance you'll be watching out for in 2013?
So for me, the key thing to focus on really is the fundamental outlook. Is business getting better in general for companies in U.S. high yield, or are things deteriorating? And I have a favorable outlook from an economic perspective. My expectation is the unemployment rate in the United States will continue to decline. The interest rate environment will stay favorable. That will provide more liquidity to the marketplace and help jumpstart business growth. And the financial health overall for companies in U.S. high yield continues to be favorable. So I have a good outlook for U.S. high yield. Again, that's tempered a little bit by the valuation. So on the whole, I look for a coupon clipping-like return for investors, which should be a 6 to 7% type of a return, I think is a reasonable expectation.
There are concerns that the current low yields offered by high yield offerings are not enough to compensate investors for the inherent risk of such debt. What are your views on this?
So while high yield is a fixed income instrument, it's far less sensitive to changes in interest rates than investment grade rated bonds or U.S. Treasuries. So rising interest rates tend to mean that the economy is improving, and an improving economy tends to mean good things for performance for U.S. high yield. So I do pay attention to what's happening to interest rates. I don't think it's going to be a key driver for performance of the asset class in 2013, and a slowly rising interest rate environment would probably mean good things for performance for U.S. high yield, because while rates are going up, again, it tends to mean an improving economy, and that means good things for non-investment grade companies.
Are there any investment ideas you are particularly bullish or bearish on within the US high yield space?
So everything that we do in high yield at Fidelity is based upon a bottom-up approach. So we're simply looking for the best companies who are positioned to continue to perform well. Not surprisingly, based upon that bottom-up analysis, we tend to be overweight or underweight certain industries depending upon the fundamental view. Currently, as the portfolio is positioned, I'm overweight diversified financial services because, in general, the common theme amongst most of the issuers is these are companies with very good balance sheets, but coming out of the credit crisis of 2008, they really want to improve their ratings profile and become investment grade. It's critically important for them to become investment grade because that reduces their cost of borrowing. So as a result, these companies are positioned quite favorably over the next 12 to 24 months, where if there's volatility in the marketplace, there's good downside protection because they have strong balance sheets, but they will continue to improve their credit ratings, and when they become investment grade, we'll see a lot of spread tightening, so there's good total return potential. These are the types of names and themes that I love in this type of an environment, where good downside protection, but we still have the opportunity for total return. So that's one industry that I'd highlight as an overweight for the fund.
Thank you.
My pleasure.